Now, as opposed to risk, which is a threatening condition to investing, let's talk a little bit about volatility, which we actually think is a friend of the value investment process. We see volatility as opportunity. And we define volatility simply as the movement of stocks around the intrinsic value of the business. So by this definition, volatility occurs both when the price of stock falls and creates a buying opportunity for us, or when the stock rises and creates a selling opportunity. Now, what can cause these extreme actions of prices? We know that investor psychology and emotions fuel some of that price action, and we know that the intrinsic value of the businesses don't change that much. So let's look at some of these sources of volatility, and I'm going to break them down in the same way I did risk, macro and micro. When we look at the macro sources of volatility, I can identify at least 4 elements. The first cause of price dislocation can occur when there's an announced change of tax policy. Sometimes that comes from the executive branch, sometimes it comes from the legislative branch, but no matter where it originates, if it looks like there is going to be a change in the status quo, that will have an effect on prices. The second source of volatility in terms of price dislocation will happen from a change or an expected change in Fed policy. This has been particularly acute recently, as you know, from the headlines with the Fed talking about its tapering policy and the changes that are involved in that. Thirdly, geopolitical events can cause volatility. Most recently, we saw this a couple of months back when there was some concern that the United States was going to get involved in an effort to attack Syria. And finally, there is very often changes in prices when there are changed expectations about the growth of the economy. We saw this most recently in 2011 during the Greek crisis and the European events, where many investors here in the United States thought that that would leak over into our borders and cause a recession. Now, depending upon the extent of these particular changes, any or all of them could cause fluctuating prices that create opportunities for us. The important thing to consider is not the magnitude of the changes that we see in the prices of these stocks. The important thing to consider is because the intrinsic value of the businesses don't change very much, we get a chance to buy and invest our monies in these companies. Now, in addition to the macro sources of volatility, there are also a couple of micro sources, or sources that are endemic, intrinsic to the companies themselves. And let me run through a couple of those very quickly. One is prices in a stock will change when there's a surprise to the earnings, or they disappoint with their earnings. Or more recently, what's happened is companies guide the street about their sales or about their earnings being higher or lower. Any disappointment there can cause a temporary change in price. Another source of micro volatility will come from an expected change in the growth rate of a company's earnings. Now, I'll use an example of our typical small cap cyclical stock. We're usually not buying these on the basis of earnings because there aren't any, but we can buy them on the basis of assets. The potential gains are modest at best, as you see in this PE example, where we'll stretch from somewhere from 7 to 9 or 10. However, when the prospects of a company's earnings improve, as you can see, so will their PE. Just small changes in expected earnings increases can lead to very large changes in PE multiples. And of course, the opposite is true. As soon as the companies hit their cyclical peak and start to go the other way, investors will reduce their expectations. Third source of volatility when it comes to stock price changes are product failures or successes. Think recently about the Apple iPod and the Apple iPad announcements and what that does to the price of Apple stock. And of course, those of you who are old enough to remember, I was the Edsel. There's a great source of product failure. A fourth source of volatility of stock prices is the death of a founder or the death of a very competent and capable CEO. Or, of course, the opposite is true, and that is you have a company that is languishing and a competent CEO joins the company offering hope and opportunity. We think we have one of those in your portfolio with a company called Lane Christensen. And we had a great experience with the CEO that you see in the picture, Rene Robichaud, who turned around a company that we had in our previous portfolios, NS Steel. Now that he's at the helm of Lane, we think he has a great opportunity to do just the same. The final source of volatility in stock prices comes from the government again, a government investigation or a lawsuit. Sometimes they will announce that there's an inquiry. Most recently, for instance, the Justice Department has been using the Foreign Corrupt Practices Act, a piece of legislation passed in the 70s, to go after companies and extract revenue for the government. So whether or not these exaggerated price swings happen because of a macro event or they happen because of some micro event, these are occasions that create opportunities for us, and we want to take advantage of them.